Good morning and welcome to your daily solo 401k webinar and Q&A session with my solo 401k financial, where we try to help you stop overpaying taxes and start building real retirement wealth. Today's topic is, can a single member LLC have a solo 401k? As always, this is your chance to get answers. Use the chat to ask questions on today's topic or anything else surrounding solo 401ks and even self-directed IRAs. Type them over so we can make sure to get to them all. Looks like we've got a question already here. Let's take a look at it here. I'm trying to fill out an online application. Is this the right place? That's right. If you go to our open account page of our website, you can open an account. Click on open account. Let me send you the link over to open the account online. We make it very easy. And we have an infographic right there that lists all the steps available. So follow those steps there, and then we'll turn around the solo 401k plan documents the same day. You sign, you upload, then you complete the next steps questionnaire where you let us know where you want to hold your funds at. One of the reasons individuals like to use my solo 401k financial is that you get to choose where to hold your funds at. It's your money, so you can choose to hold it at a local bank, local credit union, or even at a brokerage firm like Fidelity or Schwab. All right, and we'll shepherd you through the whole setup process. All right, so we'll keep monitoring the chat for any other questions. In the meantime, let's continue with today's topic, which again is, can a single member LLC have a solo 401k plan? As I mentioned earlier, go ahead and type over your questions surrounding any aspect of solo 401ks for self-directed IRAs, and we'll pause and answer those questions as they come in. So regarding the question, can a single member LLC have a solo 401k? The answer is yes. So if you operate your business as a limited liability company, you may be wondering, can a single member LLC have a solo 401k plan? So again, the short answer is yes. And in many cases, it's one of the most powerful retirement planning strategies available to self-employed business owners. So let's break it down clearly. So let's define a single member LLC. So a single member LLC is a limited liability company that has one owner or member. So owner, typically it's called a member if we're using LLC terminology. So owner means the same thing as member. Some key characteristics is that a limited liability company provides liability protection. So it separates personal and business assets. By default, a limited liability company is treated as a disregarded entity for federal tax purposes. Also, business income typically flows through the owner's personal tax return. That is Form 1040. If no formal tax election is made, a single member LLC is generally taxed as a sole proprietorship. And business income is reported on Schedule C of the owner's Form 1040. Let's keep going here. So, because the owner has self-employment income, he or she is eligible to establish a solo 401k as long as that LLC does not employ any full-time W-2 employees other than the owner and his or her spouse. Now let's talk about what a multi-member LLC is. So a multi-member LLC has two or more owners. Again, members, if we're talking about an LLC, but owner and members mean the same thing in the context of an LLC. So by default, a multi-member LLC is taxed as a partnership, and it files Form 1065. It would issue separate Schedule K-1s to each member. So let's say both spouses are self-employed under that LLC. Let's say the LLC is taxed as a partnership. Then the solo 401k plan would be sponsored by the LLC. Both spouses are partners in the business. So each spouse is going to need to file a separate Schedule 1. Actually, Schedule K-1, excuse me. They're going to have to file a separate Schedule K-1 because they each would have separate self-employment act income under that LLC tax as a partnership. So when you go to make contributions to the solo 401k plan, both spouses will qualify to make contributions, but they need to review their respective Schedule K-1. And they need to look at line 14 of that Schedule K-1, which is titled self-employment income. There also needs to be a code A as an apple in that line 14 line. So if you have a figure there that's positive, then that means you can make a contribution to the solo 401k plan based on that respective Schedule K-1 line 14 code A line. So each spouse would need to have a separate Schedule K-1 with separate line 14 code A amounts, and their respective contributions would be based on their respective Schedule K-1 from that LLC tax as a partnership. So just like a single member LLC, a multi-member LLC can establish a solo 401k plan as long as there are no common law full-time employees working 1,000 hours or more per year. And of course, if there are other owners, that's fine, because you can have multiple owners in the same business. When we talk about common law W-2 employees, we're talking about someone who is not an owner in the business. And again, the spouse doesn't have to be an owner in the business, but the spouse does need to be working in the business in order to participate in that same solo 401k plan, because the plan is sponsored by that self-employed business. So that leads us to the next slide. Can both spouses be members of the same LLC? Let's go over this slide here. So the answer is yes. As both a husband and wife can both be members of the same LLC. That means they both work in the business, so the same LLC. Both earn compensation from the LLC, so they're both working under that same LLC. So both can participate in the same solo 401k plan, because the solo 401k plan will be sponsored by that self-employed business. So this is extremely powerful for retirement planning, because both spouses can contribute to the plan. You can effectively double up on contributions. However, in order to participate in the same solo 401k, both spouses must work in the same business. You cannot use income from a separate business to participate in the same plan unless they are part of the same control group under IRS rules. So here's an example of a husband and wife or both spouses solo 401k plan. So the self-employed plan, the self-employed solo 401k plan is sponsored by their self-employed business, the LLC. So just one plan. Each spouse is required to have separate holding accounts under the plan to hold their respective funds and contributions. We'll come back to that slide here in a little bit and dissect it some more. But let's keep talking about how both spouses can participate in the same solo 401k plan. So how can an LLC be taxed? Look at that slide here. That's one of the differences between an LLC and other entity types is that an LLC can elect how it wants to be taxed. So an LLC is a legal structure, not a tax classification. So it's an entity structure, and it can elect how it wants to be taxed. That said, an LLC may be taxed as a sole proprietorship, which is again the default if we're talking about a single member LLC. It can be taxed as a partnership. So, as I mentioned earlier, you would file a Schedule K1 or two Schedule K1s if both spouses are participating in the same plan. It can also elect to be taxed as an S corporation by filing Form 2553. And then your contributions to the solo 401k plan for an LLC tax as an S corporation will be based on your W-2 wages. Box 1 of your W-2, which is the gross wages. If both spouses are self-employed in the same LLC tax as an S corporation, then each spouse will file a separate W-2 under that LLC, and their contributions to the solo 401k plan will be based on their respective W-2s from that LLC tax as an S corporation. It can also elect to be taxed as a sole proprietorship. So if both spouses are working under the same LLC, they would each file a separate Schedule C. And they would make contributions to the solo 401k plan based on their respective Schedule C, with the starting figure being line 31 of that Schedule C, which is the net self-employment income line. So they would each participate in the same plan, but they would review their respective Schedule Cs to look for a figure in line 31 to determine how much they can contribute to the plan. So the way the LLC is taxed determines how income is reported, what counts as compensation, and how solo 401k contributions are calculated. That's why when you go to our online application, we ask your self-employed business entity type and how it's taxed, because that's going to drive how the calculations are determined for making contributions. We talked about how contributions are calculated. So again, how contributions work are based on tax status. So if it's taxed as a sole proprietorship, each spouse's contribution is based on their respective net self-employment income reported on Schedule C. So the contributions, when we're talking about a sole proprietorship, you're going to look at the net profit, line 31. And then that figure in line 31 is going to be further reduced by 1/2 of self-employment income tax. Our handy solo 401k contribution calculator on our website will handle the calculation for you. Once you plug in that line 31 Schedule C figure, it'll reduce that 1/2 of self-employment income tax for you. So effectively, when the business is taxed as that, when the self-employed business is an LLC taxed as a sole proprietorship, the employee and employer contributions are going to be based on that line 31 of Schedule C after you subtract 1/2 of self-employment income tax. And keep in mind that when making employer profit sharing contributions, it's going to be, the calculation will be 20% of that adjusted net earnings. And again, the calculator will subtract that 1/2 of self-employment income tax for you from that line 31 of that Schedule C. And it'll also break down the 20% employer profit sharing contribution. If it's taxed as a partnership, then as I mentioned earlier, each spouse is going to receive a Schedule K1, a separate Schedule K1. And just like a LLC tax is a sole proprietorship, you're going to have to subtract 1/2 of self-employment income tax from that Schedule K1 line 14 code A figure. And the calculator will do that for you, because you have to subtract 1/2 of self-employment income tax before you get that net self-employment income figure. And then each spouse's contribution is based solely on their own share of Schedule K1 partnership income from that LLC taxed as a partnership. If the LLC is taxed as an S corporation, it's going to be a little different. the contributions are going to be based on W-2 wages paid to each spouse from that LLC, taxes, and S corporation. It's not going to be based on business profits. It's going to be based on W-2 wages, which is gross wages, box 1 of that W-2. So in this case, employee deferrals are going to be based on W-2 box 1 wages. Employer profit sharing contributions are going to go up to 25% of W-2 wages as opposed to 20%. That's one of the advantages of an LLC tax as an S corporation from a contribution perspective over an LLC tax as a partnership or LLC tax as a sole proprietorship. That is that you don't have to subtract 1/2 of self-employment income tax in order to perform the solo 401k contribution calculation. So it takes less earned income from self-employment activity when your business is taxed as an S corporation to contribute the overall limit to the solo 401k plan, which is $70,000 for tax year 2025, and increased to $72,000 for tax year 2026. So again, each spouse must receive reasonable compensation in order to contribute and have enough earned income from that LLC tax as an S corporation in order to maximize their contributions. Because remember, when you make contributions to a solo 401k plan, regardless of how that LLC is taxed, you need to have enough earned income from that self-employment activity to be able to contribute up to the maximum for the year. So that's why the IRS created solo 401k plans to shelter your taxable earned income. And that's why all contribution types have to be based on your net self-employment income. They cannot be based on capital gains, interest income, personal assets. It's got to be based on earned income from self-employment activity. Now, if both spouses want to participate in the same solo 401k plan, then both spouses must work in that same business. So they're going to have to perform self-employment activity services under that same LLC. And they both must receive compensation in order to contribute to the plan. So if one spouse receives earned income from self-employment activity to the LLC and the other one doesn't, then spouse 1 can contribute, but the second spouse cannot. Because in order to contribute, you have to have separate self-employment income under that LLC. So again, contributions must be calculated separately. And the annual contribution limits apply on a per person, per participant. So if each spouse has enough net self-employment income under that LLC, they can each maximize their annual contribution limit, which again is $70,000 for tax year 2025 and $72,000 for tax year 2026. So talk about really supercharging your retirement account savings when both spouses participate in the same solo 401k plan. So each spouse is going to have their own separate employee contribution limit, their own separate catch-up contribution limit, and their own overall annual limit. So again, this can potentially double the family's retirement contributions. Now, bank and brokerage accounts, 1 participant versus 2 participant. So the administrative structure changes depending on how many participants are in the plan. And let me get over to that slide here. So this is an example of a 1 participant plan. So if only 1 participant, that is just 1 spouse, for instance, then that 1 spouse would have separate holding accounts for each source of funds. You would have a pre-tax, a Roth, and a voluntary after-tax. It's still just 1 plan. It's not 3 separate solo 401k plans. It's 1 plan, but because a solo 401k is a defined contribution plan, you are required to have separate holding accounts for each source of funds. So this slide here shows 3 separate bank or brokerage accounts. So if you use Fidelity to hold the funds, for the solo 401k offered by my solo 401k financial, we would help you to open up 3 separate brokerage accounts at Fidelity. One to hold the pre-tax solo 401k funds, the second to hold the Roth solo 401k funds, and the third one to hold the voluntary after-tax solo 401k funds. Now, here's an example of a 2-participant plan. Let's say both spouses are self-employed under the same LLC. So the plan is sponsored by the LLC, the self-employed business. So it's still just one solo 401k plan. But here you're going to have 6 separate brokerage accounts or bank accounts, aka holding accounts under that plan. Because you're required to have separate holding accounts for each participant, in this case, each spouse, as well as each source of funds. That's pre-tax, Roth, and voluntary after-tax. So this type of separate tracking is going to ensure clean accounting. And again, it's an IRS regulation that you have separate holding accounts for each source of funds and each spouse, because the solo 401k is a defined contribution plan. It's not a defined benefit plan. And this is also going to ensure proper tracking of each participant's balance, as well as source types. And it's going to ensure accurate reporting for distributions and conversions. So the solo 401k is one plan, just one plan, but both participants participate in the same plan. Therefore, there's separate participant level accounting by utilizing separate holding accounts, aka bank or brokerage accounts. What if there is only one member in that LLC? Well, if the LLC has only one working spouse, then again, only that spouse can participate in the solo 401k plan. And then the contributions are based on that spouse's earned income. And only that participant's holding accounts are needed to be established if there's only one participant. If the spouse later on wants to participate in the plan can be amended and the spouse can be added to the plan. And then he or she would need to open up separate holding accounts, aka bank or brokerage accounts, to hold his or her contributions, or if he or she wants to transfer IRAs or former employer plans to the solo 401k, those holding accounts would also be used to hold those funds. Okay, so let's talk about some final takeaways. Let's get to that slide here. So again, yes, a single member LLC can absolutely establish a solo 401k plan. Even better, a multi-member LLC can also establish a solo 401k plan. So a husband and wife can both participate in the same solo 401k plan as long as they're both working under the same business. And the LLC can elect its tax treatment, whether it wants to be taxed as an S corporation, partnership, sole proprietorship, for example. Contributions are based on each spouse's compensation under the LLC's tax structure. Separate holding accounts must be maintained for each participant in each source of funds. So when structured properly, a solo 401k for an LLC can maximize retirement contributions, allow Roth and mega backdoor Roth strategies. So each spouse under that same solo 401k plan can process their own separate mega backdoor Roth strategy. It also will provide flexibility in investments in that you can choose to invest in equities, alternative investments like real estate, cryptocurrency, precious metals, promissory notes, tax liens, the list goes on, and potentially double retirement savings for married business owners. What is more, each spouse can borrow from the solo 401k plan through a solo 401k participant loan where they can borrow 50% of their respective solo 401k funds in the plan up to $50,000. So if they each have enough solo 401k funds in that plan, they can each borrow $50,000 for a total of $100,000, and you can use those borrowed proceeds for any purpose. There's no credit check. You use the funds for any purpose. You can use them for paying off bills or expanding your business. You would have to pay back over a 5-year period, consisting of fixed payments, monthly or quarterly payments made up of principal and interest. If you use the borrowed proceeds for the purchase of your primary residence, then you can extend that loan to a 15, 30-year period. All other purposes, the maximum solo 401k participant loan period is 5 years. So for self-employed entrepreneurs, the solo 401k remains one of the most powerful retirement planning tools available. Okay, let's take a look at some questions here. Here's a question. If my spouse does not work in my sole member LLC, can he still be co-trustee? Yes. So there's a difference between a participant and a trustee. In order to contribute to a solo 401k plan where you want to make annual contributions, or if you want to consolidate retirement funds by transferring IRAs or former employer plans to the solo 401k, you must be a participant in the plan. However, as trustee, you don't have to be a participant in the plan. So yes, you can certainly name your spouse as a co-trustee so that he or she also has signing authority over the account without having to be a participant. And many of our clients do name their spouse as a co-trustee. Good question. Here's a question here. Can I set up a solo 401k for a contribution that would count towards 2025 taxes? The answer is it depends on your self-employed business and also on the contribution type. Let's see if we can get to that. Good question. I think I have some slides here that go over that. So yes, there's still time to open a solo 401k plan here in 2026 so that you can make tax your 2025 solo 401k contributions. But there are some certain caveats, just like everything else in the Internal Revenue Code. You always have caveats. So it's going to depend on the contribution type and how your self-employed business is taxed. So for example, if your self-employed business is taxed as an S corporation, then you can open a solo 401k plan in 2026 and make tax your 2025 solo 401k contributions, but only certain types. You're going to be able to make employer profit sharing contributions and voluntary after-tax solo 401k contributions. And you're going to have to open the solo 401k plan and fund it by March 15 of this year to make tax your 2025 solo 401k contributions. If you file a business tax return extension, however, for that S corporation, then you're going to have until September 15 to open the solo 401k plan and make both employer profit sharing contributions as well as voluntary after-tax solo 401k contributions. However, and listen carefully, you will not be able to make employee solo 401k contributions for a business tax as an S corporation if you are just opening the solo 401k plan for the first time here in 2026. Those have different rules. Now, if you had opened that plan by December 31st of 2025, that means establishing the plan, also known as adopting the plan, which means signing the plan documents, then you would be able to make all contribution types for the prior year here in the current year. That would be employee, employer, and profit sharing. Now, for an LLC, for a sole proprietorship, I've got great news for you. It's very advantageous. So if your business is a sole proprietorship or an LLC taxed as a sole proprietorship, then you're going to be able to make all contribution types: employee, employer, and voluntary after-tax solo 401k contributions. For tax year 2025, here in 2026, if you open the solo 401k plan here in 2026. And of course, if you already opened the plan by December 31st of 2025, then that also applies to you. You can make all contribution types. But to review here, if your business is taxed as a sole proprietorship and you have not yet opened the solo 401k plan and you want to make prior year contributions, so that's tax year 2025 contributions, here in the current year, which is year 2026, and your business is taxed as a sole proprietorship, as long as you open that solo 401k plan and fund it, and fund that plan by April 15 of 2026, you're going to be able to make all contribution types: employee contributions, employer profit sharing contributions, and voluntary after-tax solo 401k contributions. So this is one small example of where a business tax as a sole proprietorship is more advantageous than a business tax as an S corp or partnership, and that's the contribution deadline for employee contributions. So if you file an extension for that Schedule C, so Form 1040, then you're going to have until October 15 of 2026 to open the solo 401k plan and only make employer profit sharing contributions as well as voluntary after-tax solo 401k contributions. Therefore, you would not be able to make employee solo 401k contributions after April 15 of 2026 for tax year 2025 if you're opening the solo 401k plan for the first time here in 2026. So take a look at that information there. As a matter of fact, let me send a page from our website that talks about the various contribution deadlines for each self-employed entity type. It's a really good tool to have. So take a look at that right there. Okay, let's see if we have any more questions here. Here's a follow-up question. So my question above applies for my consulting, which I did in the first half of 2025. I then took a W-2 paying job with my current employer, which offers a workplace 401k. Does that complicate things? Not necessarily. We actually have a lot of clients that participate in their full-time employer 401k, and they also have a solo 401k plan. So talk about being able to double up on contributions. They're able to double up on their voluntary after-tax solo 401k contributions and employer profit-sharing contributions. The key is that you have enough earned income from self-employment activity from that side business in order to contribute to the solo 401k plan, because you can only contribute to that solo 401k plan based on your earned income from self-employment activity, not on your, it cannot be based on your W-2 wages from your daytime employer. All right, let's see if we have some more questions here. Here's a question here. Before I hit the payment button, one more question. Will someone contact me before drawing up the documents? Actually, no. That's because we draft the solo 401k plan documents for the maximum flexibility under the law, where you're going to be able to borrow from the plan through a participant loan. You're going to be able to make employer Roth contributions, employee Roth contributions. You're going to have the mega backdoor Roth strategy. You're going to be able to invest in equities, alternative investments. It'll have the $1,500 auto contribution credit. So we draft our plan documents for the maximum flexibility under the law, and you're not required to use every feature, but it's drafted for the maximum flexibility under the law. So good question. All right, it looks like we don't have any other questions for now. We're about to finish up here. We'll be live. As a matter of fact, we'll be live again here in a couple hours. We go live every day, at least once a day, and many times twice a day. So today we're going to go live again here in a couple hours. So if you haven't yet, please like and subscribe to our YouTube channel so that you receive notifications regarding when we go live. Please also like us across the various social platforms, as it helps us to get the word out to other solopreneurs like yourself. So that's it for today's session. Thank you so much for investing your time with us. We know your time is valuable, but we feel that your future depends on it. So again, if you haven't yet, please like and subscribe, and we'll see you here in a couple hours. Until next time, have a good rest of the day.